Hello, everybody, and welcome to today's webinar event to discuss the concept of the doubling game. Now, I have to confess that this is something I know little about, but my special guest today is Courtney of Plenitude Wealth, who is an acknowledged expert on the doubling game. And Andrew today will explain how it's possible to double your net assets and to keep doubling them to get to $1 million. And ultimately, if you're really successful, get to $1 billion. And I'm intrigued to find out more about this and the part that property investment plays in helping investors achieve success with a doubling game. So Andrew, Courtney, welcome.
Thank you very much for having me, Terry. Much appreciated.
Now, look, perhaps we could start by, if you could just tell us a little bit about yourself and Plenitude Wealth and what you do and how you can help people with property investment and other forms of wealth creation.
Yeah, sure. So a little bit about myself. Like in the previous life, I was a medical researcher. So I did some science, I did some breast cancer research along with some skin cancer research and developmental biology. And during that time, I started investing in property and fell in love with the idea of building a passive income through investments. And I caught myself talking to all the scientists about their finances, and I thought, I think I'm onto something here. So I decided to basically transition from science into finance. I started a Master of Commerce majoring in applied finance and transitioned out of science into financial planning. So here I am today, basically 3 businesses later. We've got a financial planning business, a mortgage broking business, and a buyer's agency to ensure that we provide, I guess, maximum value to our clients to get them to financial freedom a hell of a lot sooner, right? Because what we found was we were referring to, so we started off as financial planners, right? We were started to refer to mortgage brokers, but unfortunately, it wasn't quite right in terms of the, I guess, the service standards that we were expecting for our clients. And then as soon as we got that in line, I should say, we found that our clients were struggling to buy properties. So we decided to establish the buyer's agency as well. So now we run 3 businesses, basically.
Sounds like you're heading towards becoming a one-stop shop for investors.
That's absolutely the idea, Terry. Yeah, just to save them time, get them to financial freedom sooner, get them financial resilience, right? And so that they can go chase after the right experiences that they want in life.
Okay, so that's a little bit of background about yourself and your business, but recently we started chatting to this concept about this concept of the doubling game, which I'm a little bit intrigued about. And as you explained it to me, I became more and more interested. So we've advertised this as the topic for today's webinar, and we've had particularly strong take-up. So obviously it's a topic that struck a chord with a lot of people out there, and intrigued with the possibility of just keep on doubling your wealth until you get to the point where you're fabulously wealthy. So tell us about that.
Yeah, so it's a really simple but powerful concept, right? So imagine starting off with $1,000, you double it once, you get to 2,000, and you double it 9 more times. So 10 doubling cycles will get you from 1,000 to $1 million, right? So from 10 more doubling cycles from 1 million will get you to 1 billion. So in our lifetime, if you can double 20 times, you become a billionaire, right? Now, most of us in this webinar probably ain't gonna go for that kind of number in terms of our net asset position. Now, some of us will be happy with 10 mil, others will be happy with 8, 4, some at 16, maybe 32, right? Depending on how ambitious you are will determine what kind of actions you need to take today to double your net assets faster, because obviously time is running out, especially if you've got a big goal ahead of you, right? So what I want to do is go through the nitty-gritty with everyone in this webinar so that you can actually run the numbers yourself to work out how you're tracking with your doubling game, how many cycles you've actually achieved thus far, and what kind of time frame it's going to take you to get to your next doubling cycle, along with how long will it take you to get to the following doubling cycles, which gets harder and harder as time progresses.
Yeah, so it sounds easy in theory, but I imagine the practicality of it is a little bit more difficult, particularly getting to those really big numbers. So just how does it work for the average punter?
Yeah, well, it starts off with, you always have to start off with the end in mind, right? So what I might do is I'll quickly share my screen with you so that we can go through some drawings of mine, so you can see how it all works. Okay, here we are. Okay, hopefully, can you see this okay?
Yes, I can see it.
Okay, fantastic. Okay, so here we are. So there are two key variables that everyone must consider when setting financial targets for themselves. There's income, right? And then there's the capital, right? So what you want to do is you want to set some targets and what kind of passive income do you want in your life from your investment portfolio? Because right now, the majority of us in this particular webinar is actually trading our time for an income. And in an ideal world, from that income, you're building up a surplus, right? And building up your capital. And ideally, you get a return on investment on your net asset position. So much so that it grows to a certain amount. We'll start working on the goals a little bit in a minute's time, right? Where it spits out an income for you so that you don't have to trade your time for an income anymore. So that's the first, those are the first two variables. So what we want to do is we want to start with the end in mind. So I've taken the liberty of wanting to introduce to you Jack and Jill, right? Jack and Jill is a household, basically. So parents of two kids, essentially, right? And these are their salaries, right? 275 for Jack and 27K for Jill, basically. Their savings of $25,000 per annum. And their asset position is approximately 1 mil, right? They've got their principal place residence worth 1.03, 1.1-ish, right? And they've got their superannuation balance of just shy of $400,000, right? So that's where they're at. And what we want to do with Jack and Jill is set some targets, right, for themselves. So what does that actually mean? So we've got income and capital targets. And as I mentioned earlier, they're both intertwined with one another, right? So how it works is this. What we want to do is we want to set a arrive number for an income target, passive income target, right? So for Jack and Jill, they've decided to aim for, let me just go to my cheat sheet, right? They've decided to go for $300,000, right? So $300,000 as their initial passive income target for their household, right? So how do you start that? So for the people in this particular webinar, what I suggest you do is have a think about how ambitious you want to be in your target setting, right? So the bottom of the range is your yearly expenses, right? Because financial freedom is equivalent to you being able to replace your current income to pay for all of your yearly expenses. So that's the bottom target as far as I'm concerned. The top target is your gross salary, right? So what are you currently, what's the take home pre-tax, right? So some people will be on $150,000 expenses, and then let's say $250,000 worth of top line income, right? So you've got to choose between those two numbers as your initial arrive income goal, right? So once you've chosen, what I suggest you do is you draw this table out. And if you're interested in learning more and doing this, because I might be going through a little bit quickly, what I'll do is I'll share a quick link on the chat box right here, right? Where you can go and download the particular workbook that we've created for you guys, basically. So what will happen there is you can download the workbook and you can go through this whole process yourself, right? So for Jack and Jill, they've got $300,000 for their arrive number, initial number, goal. So what we want to set for Jack and Jill is a stretch goal, the strive number. What does that mean? For them, they decided for a $400,000 passive income per annum, right? And then the thrive number, which is a big, hairy, audacious goal, which is designed to sort of scare them a little bit, they decided to add another $100,000 on there, right? So these are their targets. Now, sizable targets, right? You may as well go big when you're setting some targets for yourself, because you can start asking more quality questions around how you can solve that particular problem, right? So what we do now is multiply that out by 20, because you can consistently get 5% return on investment on your net asset position to produce the income you need from your capital, right? So multiply that out, we need 6 mil, 8 mil, and then 10 mil. Net asset position invested at 5%. Now, quite huge numbers, right? So what we want to do now is work out, well, how do we get there ASAP without losing sleep? Right? I call this thing the sleep test, right? You want to pass the sleep test with everything that you're doing. So you need to play conservatively to begin with, learn the ropes, make sure you're doing the right strategies that pushes you to get a better outcome, essentially, right? So within the context of the doubling game, they're hovering around that 1 mil mark, right? So they want to get to 6 mil sooner rather than later, right? 8 mil and 10 mil as their targets, right? So what they want to do now is work out, well, how many cycles will it take them to get to 6 mil, 8 mil, and then $10 million, right? The next question is, well, how long will it take to produce their first doubling cycle? Because right now they're sitting right here, right? Enter your net asset growth per annum. There are 3 core metrics that I always go through with individuals and in households on how to calculate the doubling cycle, right? Have the speed of the doubling cycle. It comes down to savings, taxes saved, and the return on investment on their current portfolio. So for Jack and Jill, they've got their house and they've got their super, essentially, right? If they want to ignore super for now, right, what they can do, because let's say they're in their late 30s, they don't necessarily want to consider their super, so they've got their $1.1 million house, right? So we would work out, well, with that in mind, at a 5% return on investment in terms of growth, they're getting $55K per annum, right, on their return on investment, right? What else is going on? So they've got that, they've got their principal place of residence, they've got $25,000 of savings, right? So on a year-to-year basis, they can save $25,000. So what I suggest you do is have a think about what kind of surplus you can have for your particular household and write it down. So what are the 3 core numbers for you? Because what we want to do is we want to add it up and divide it by the net asset position, right? So taxes saved for Jack and Jill, let's have a quick look at the cheat sheet again, 4K basically, right? So 4K. So I prepared this earlier. So we'll go through the exact numbers for Jack and Jill shortly, right? And what we've done is we've looked at their net assets outside of super, right, of 520K, basically, right? So if we add up 25 plus 4 plus 55, 25 plus 4 plus 55, we get to $84,000, right, of net asset growth per annum, right? So have a think about what portfolio you have. So let's say you've got multiple properties in your portfolio, right? And let's say a share portfolio, right? What you do is you work out, well, what kind of growth can those properties get you, right? Ignore cash flows for now, right? Just have a think about what kind of growth. Is it 3%? Is it 4%? Is it 5%? Is it 6 or 7% that you can bank on year over a 15-year period? If you go with 5%, that's reasonably conservative, obviously, right? So run with that and work out, well, what kind of number you can actually produce or your portfolio can produce for you. So we get to, for Jack and Jill, 84K divided by their net asset position at 520, right? So 84 divided by 520 is 16.2%, right? Then we enter the rule of 72. So some of you may have heard of the rule of 72, where instead of a net asset growth, they look at what kind of return on investment you would need to double the initial investment that you put in. So by creating this particular formula here, where you're looking at savings, tax saved, and return on investment, we get to look at how long will it take you to double your net asset position with the rule of 72, right? For Jack and Jill, it's now at 16.2%. So what we do is we go 72 divided by 16.2 equals 4.4 years, right? So what happens then is we go back to their initial position, i.e. 520K, right, of outside of super money, because they want to focus in on outside of super, right? So we look at this where they're starting at 520. So the next doubling cycle becomes 1.04 mil. Next doubling cycle, 2.08. Next is 4.16. Next is 8.32. And then last one is 16.6 mil. Right? So if we add all that, if we work out the number of years for the initial doubling cycle, we get to 4.4 years, essentially. Right? Now, the hardest part is this. As the doubling cycles progress, it gets harder and harder. It doubles each and every time, right? So it goes from 4.4 to 8.8, right? 17.6, 35.2, right? And 70.4. So this is the scary part. For Jack and Jill, with their current strategy, to get to 16 mil, 16.6 mil, it'll take them upwards of 100 years, well and truly above 100 years, right? So what they need to do is reassess what kind of savings they've got. How do you increase the savings? How do you increase your taxes? And how do you increase your return on investment to increase the net asset growth percentage on a year-to-year basis? So that's pretty much the doubling game in a nutshell. I've thrown a whole bunch of numbers at you, Terry, and the audience of this webinar. So feel free to kind of nitpick and ask any questions you got on that one.
We've got a number of comments from people in the Q&A panel saying that the chat box is disabled. They can't actually see that link that you'll put. I'm not sure why people aren't seeing their chat box. I can see it, and I can see the link that you've put in the chat box. Can you perhaps place that link in the Q&A panel rather than the chat box?
Yes, Q&A. Okay, let me. Okay, I'll type it in for Scott. There you go, Scott. I will answer with link. There we are. Yeah, there you go. So the first answered question is where the link is, right? So Scott Tappan, thanks for that comment, mate. 275 salary for Jack. He's doing pretty well for himself. Absolutely. Obviously, he's definitely a high flyer when it comes to the income. Jill, on the other hand, is a little bit lower. So maybe some households will be hovering around that 200,000 total household income, potentially 250, right? So every single household is different, and what you need to do is work out how it works for your particular situation, and that's why going through this exercise is actually quite powerful for you, right? So any other questions, Terry, on this before I sort of get on to the next stage of the doubling game?
Just a comment that Katie in the background has put into the chat box saying that what you place there is the link is only for hosts and panelists. You need to make it for everybody, so people in the chat box can see it in the chat box.
Yeah, what we'll need to do, Katie, is because I'm not a host, I don't have that option available. So if you can cut and paste that would be fantastic, and then share it to everyone. That's probably the best way to do it, because I'm not a host, and I don't have that facility. There we are. Fantastic. Thanks, Katie. Much appreciated.
Okay, so
Brilliant.
hopefully now everyone can see that link. That's the workbook. Pasted it in the chat box. It's also there in the Q&A. Now, I think some people may have, their brain may be about to explode at the permutations of what you're just going. Sam saying, can you please repeat how you get to 16.2? And that was
Yes.
their rate of return that was used with the rule of 72 to start to do some of the time calculations.
Yes. Okay. So how it works is this: your net asset growth, right, per year is the crucial calculation, right? 3 core numbers that you need to consider. There's savings, your surplus that is invested, put into your portfolio, whether it be plowed into your offset account or redraw facility, or dollar cost average into another portfolio, or paying down your debt with your investment properties, for example, right? So that's the savings, right? Your taxes saved is what taxes, whether it be if you're negatively geared at the moment, what kind of taxes are you currently saving and putting towards your portfolio on a year-to-year basis, basically, not taxes saved and spent, right? Post-tax returns, right? Taxes saved and added to your portfolio. And then the return on investment will be determined by the different portfolios that you currently own, right? The different portfolios that you have within each household in this particular webinar, right? So what happens is you divide it by your net asset position. And then it spits out a decimal. You multiply that by 100, and then you get to a percentage. Enter the rule of 72, right? So for Jack and Jill, they got 16.2% net asset growth because of their savings, the return on investment, the growth part of the equation, right? And the taxes saved. So this first doubling cycle is 4.4 years.
And that's achieved by dividing 72 by 16.2.
Correct, exactly. 72 divided by 16.2 equals 4.4 years, exactly. right? So we've got a video on the doubling game workbook there if you want to go through that step-by-step process as well, basically, to show you exactly how you're currently tracking, right? To ensure you know what kind of output or what kind of time frame you've got to achieve your arrive, strive, and thrive numbers, right?
Okay.
So,
and of course, the numbers are going to be different for everybody. There's no one set
correct.
of numbers. This is a case study, but everyone's numbers will be different. Everyone's starting point will be different.
Absolutely.
Sandeep was asking, do you have a calculator where they can put in the numbers and do the calculation? Is that something that's in the workbook, or is it something that needs to be done manually to a certain extent?
It is a manual thing at this particular stage in time, but that's a great feedback. We will create a calculator. It should be reasonably straightforward to calculate it out.
Yeah. Okay. All right. And another comment was, can you please go slowly? I think there are a lot of numbers and a lot of steps, and it might be challenging for a lot of people.
Yes.
Hmm.
Now, towards the end of this particular webinar, we will have a 30-minute strategy call where I will go through all of your particular doubling game numbers, if you'd like, right? I'll happily spend time with you guys to kind of show you how you're currently tracking, right? So that you know exactly what kind of time frame you're working with here, right? Especially if I'm going too fast, because there are a lot of numbers, and I can understand how it can be quite confusing. Yeah.
So what we'll show on screen before the end of the webinar is a way to follow up and make a booking to spend some time with you, so individuals can go through their particular situation and number and see what's a realistic goal to be achieved.
Absolutely. And then what happens is you overlay what you're currently doing with more precise numbers, right? So for example, for Jack and Jill, they've got their principal place of residence. So what we can do is we can run a few annuity calculations, right, to work out what the time value of money is over a 15-year period. So they've got a $1.1 million property, let's say a 5% growth. So that over that 15-year period, it starts to grow tremendously, right? So let me skip past a few things. So this is their current trajectory here, right? So this $1.1 million property at 5% growth, right, grows to 1.93 million worth of equity because they paid down their loan of 600,000 down to 350. And since they're capable of saving $25,000 per annum and paying down their loan at 4%, let's hypothetically say, over that 15 years, that $500,000 that they'll end up with will be paying that loan off, right? So therefore, if they do exactly what they're currently doing today, they will get to 2.43 mil worth of net asset position in a 15-year period. Not a bad chunk of change for Jack and Jill, right? And
that's predicated on the value of their property growing at an average rate of 5% a year. Is that what you're suggesting?
Correct.
Because that certainly, I'm always every day I'm looking at numbers for locations and what's the average annual growth rate been over the last 10 years. 5% is actually quite a conservative growth rate. Most locations around Australia currently have considerably higher growth rates than that. So your projections there are quite conservative, which I think is a good thing to do. So people aren't becoming too enthusiastic about what can be achieved. They are realistic numbers.
Yes. It's always good to project out in conservative numbers, because I've made the mistake of projecting out at 10%, and I was a billionaire in no time. So it's not exactly the best way of projecting out at 10% or potentially 12%, because some people will say all properties will double in 7 years. Not the case, obviously. So you need to kind of project out with a smaller number so that you can outperform the baseline at the very least. Right. So what we did for Jack and Jill, right? So essentially what we did is came up with a strategy to look at their doubling game and to optimize for a better outcome, right? So we looked at a $6,000 increase in taxes saved, right? We kept the savings at 25K, and then we increased their return on investment from 55 grand to $114,000, right? Therefore, we're going from a net asset growth of 84K up to $149,000 per annum, right? We divide that by the net asset position, and now we're going from 16.15 to 28.6%. So what does that look like in the rule of 72? 72 divided by 28.6 is 2.5%, right?
2.5
So if
years.
sorry, 2.5 years, beg your pardon. Yes, thanks, Terry. 2.5 years. So by making those changes, you're basically saving them a bunch of time, right? So for Jack and Jill, you can imagine this is actually a client, so I've changed their names just to keep them anonymous. But these are exact numbers that we're working with, right? So we're looking at that. We're going from 4.5 to 2.5, right? So to get to 10 mil at 85.5 years, right? We're going to 47.5 years, thereby saving them decades to get to 10 mil, right? For the 6 mil target, we're going from 49.5 to 27.5, right? So really, we're saving them 22 years for that initial arrive goal, right? The beauty of this thing is it's a snapshot in time. Let's say you're working with someone for, let's call it 10 years, right? This is a snapshot in time of what you can do in 1 year, right? Guess what? You can always optimize for a better outcome year in, year out to capitalize on the opportunity you've got in front of you, or tap into more of the potential that you've got. Therefore, this becomes the new baseline for year number 2, right? So you can see where I'm going here. What happens is you've got this line. This is the current trajectory. Future trajectory will start to do that. And as you work through, you start to save a whole bunch of time. This is your net asset position, basically. So what we're trying to do is trying to save decades of time to get to the next level. That's the game that we want to play within the financial context, right? So for Jack and Jill, we did exactly that. And the proposed trajectory looks like this, right? Jack and Jill buys 2 investment properties at a growth rate of 6%. So we've increased it by 1 because we've got Hotspotting to help us, right? To speed up that growth, right? So we picked the right spots. So we're now growing at 6% per annum. We buy 2 $400,000 properties that's high yielding, right? So it doesn't cost them that much, right? And over that 15-year period, that $400,000 property will jump up to 958 grand at 6%, which is still reasonably conservative, right?
Yeah.
658K net asset position and a cash flow position of 2K on average over that 15-year period gets them 54K, basically. Invested again at 6%. So these aren't huge numbers, right? But what happens is instead of getting 2.43, right, they're now heading towards 4.19 because they've also invested in other things. Now they're diversified across multiple properties, multiple states, multiple LGAs, along with different asset classes as well, because you don't want to put all your eggs in one basket. Where most Aussies fall for, the trap that most Aussies fall for is they invest in a really, really massive asset. They utilize their borrowing capacity, which is the catalyst for massive wealth creation in Australia, right? And they're stuck for 5 to 10 years before doing anything else, right? So for Jack and Jill here, by just adding a couple of properties in their portfolio, along with a diversified portfolio, they're going from 2.43 to 4.19. Now, what if they did exactly the same thing? Well, not exactly the same thing, but something similar to their superannuation, right? So their super invested, let's call it an ART or wherever it is, Sun Super or Hester or Host Plus, getting them 7% per annum, right? What if they went to another super fund, like a self-managed super fund, where they acquire a property, right? They add some pre-tax contributions into super, right? And they basically do the same thing, but they're aiming for 1% more. So they're a little bit more strategic in their approach. So what's happened there is they're going from 1.9 mil all the way to a whopping 3.27 mil, right? So essentially what we've done is we've added an extra 1.76 mil by adding 2 properties in the portfolio and get a diversified investment, a portfolio for them, along with the superannuation of an extra 1.37 over a 15-year period, right? So what happens is it speeds up the doubling game tremendously so that they build massive momentum, and it's a machine that never, ever stops, right? Because how you build the portfolio looks a little bit like this, right? Because what I always say is what you do in the first 5 years will determine how comfortable you are in the next 10. Therefore, you must look for squeezing as much juice out of the orange as possible, i.e. looking at your current resources and maximizing the output that you're producing currently to get the momentum that you need to live a comfortable life in 5 to 10 years time, basically. Right. So what we want to do is within the first 5 years, explore what options, real options you have available to you, not the status quo options that the media will tell you, which is basically pay down that home loan ASAP and hope for the best in your superannuation fund. Right. We want to get active in your approach so that you can actually become a little bit more comfortable.
So when we were talking about this, as we were planning this webinar, Andrew, you made the point that it's impossible to achieve the sorts of levels of wealth that you're talking about today unless you're an investor. And also it helps if you have a business, you've got a scalable business and you're an investor and you've got all those things working for you. It's very hard to achieve unless you're being proactive in the manner that you're talking about.
Absolutely. Because if you look at these numbers, right, 70 years to get from 8 mil to 16 mil, right? So this is where the business, if you've got a scalable income, suddenly it makes life a hell of a lot easier because your savings can be a hell of a lot higher than 25K. But not everyone's aiming for 32, 50 mil worth of net assets. You know what I'm saying? So if you're aiming for 8 mil, well, it's reasonably doable if you have the right investments in your portfolio. Now, if you're an investor, if you're a business owner, you can build enterprise value within your business to amplify the returns again, right? And if you can build a succession plan to allow your equity to be sold off, what happens is you start to build that momentum once more. It's all about momentum building, right? Sure. That's the game that we play here, right? And ultimately, as a investor, what we need to do is work out, well, what's the best way to diversify and what kind of returns on investment should we be aiming for, right? I'm inclined to think at the very, very start, we want to focus in on capital growth, right? Within the context of property, you want to capitalize on your borrowing capacity, cash on, and aim for cash on cash return. Far too many people are obsessed with paying it down, getting it a full ownership on the property. I'm inclined to control 100% of the property, first and foremost, maximize the return on investment. And then once you get close to that net asset position, you start to unravel and be strategic in your approach and not pay ridiculous amounts of taxes, because this side of the equation, this side of the timeline, is when you transition from a growth-centric portfolio to a more income-producing portfolio, right? Most people fall flat because all they know is one thing, right? And they don't know how to transition. They pay way too much taxes. They're at 45 cents on the dollar year after year, or in one big year because they sell it all off in one year. You need to understand what kind of sequence of events you need to put in place to maximize the output for your particular resources, yeah, and to produce the results that you want, which is ultimately your arrive, strive, and thrive numbers, right?
Now, I encourage everybody out there watching and listening to give us your questions, bang them into the Q&A panel or the chat box. The Q&A panel seems to be working best at the moment. And Sam has asked the question with reference to the part that you mentioned that super can play in accelerating the process. Sam is asking whether there's a minimum super balance required to make this work for you.
Well, look, if we're working together, it would be a minimum of $350,000, right? Other advisors would probably provide you with maybe 100,000, maybe 200,000, but I'm a little bit conservative in nature in the way I approach super. It needs to be diverse, but there's a bunch of rules associated with it, and I don't want to get into hot water. Therefore, I'm a little bit conservative when it comes to that. So 350 is the starting point where I'll start entertaining the idea, right? Other advisors may look at it lower, and other advisors a little bit higher, right? So hopefully that's answered your question, Sam. Okay.
There's a number of people making comments interested in the idea of a 30-minute appointment. HR is asking, can I book the appointment privately? Already, they say, I am looking to the future with your numbers. So what we do plan to do before the end of the webinar is have put a slide on screen that gives you the details of how you can book those appointments with Andrew to have a look at your own personal situation. Yeah, absolutely. Yeah, we'll have a few weeks organized. Now, some of you may miss out, so just book far in advance if you do. We've opened up we usually do a 15-minute call, but because you're in this particular webinar, we're happy to open it up to a 30-minute call so that we can go through your exact numbers. Yeah. Another question has popped into the Q&A panel. What is the logic of including your home in the net asset-based position if you cannot get an income from this? What's the assumption?
Yeah, so back to the let me share my screen again. Back to the investment focus. All right, so essentially, you've got soft equity or lazy equity sitting in your home, right? So all you're doing with your home is getting capital growth, right? That's all you're doing with that equity. So no matter what kind of equity position you have, so long as your cash flows can warrant a investment cash out loan, you can actually pull out some of that equity, soft equity that's sitting there doing nothing, saving you 4.5% or 5%, whatever your mortgage rate is, right? And aim for a higher return on investment, right? Therefore, you should be taking that into consideration as you build your wealth, because far too many people are sitting on massive amounts of equity in their portfolio, especially in their houses, right, in their principal place of residence, because all they know is to pay it down ASAP. I'm inclined to push the envelope a little bit more and utilize some of that equity, not all of it. I mean, you don't have to go up to 95%. Some people will go up to 80%. Others will be happy with 30% loan to value ratio, right? So it all depends on your risk profile, what you're willing to achieve, or how ambitious you want to be, because ultimately, if you can load up and actually put yourself in a position to get a higher return on investment, because what you're doing is this, right? Your dollars are either going to lower debt, which is basically getting you a return on investment of 4.5% to 5%, depending on what kind of loan you've got, or it's getting you a return on investment. So the question is, what kind of returns can you get as an investor with the cash and the capital available to you, right? So you've got two clear options. You've got your property portfolio, or you've got your shares, dollar cost average into funds, for example, right? So this one will produce, let's call it 7 to 12%. And then the property will produce, let's call it 6 to 11%. But the difference is this: you got your borrowing capacity. So you could literally buy a $500,000 property with as little as $50K with a 5% loan, or $100K with a, sorry, not a 5%, a 95% loan, or an 80% loan with a $100K deposit. Right? So it's up to you what kind of risk you're willing to take. And if your ambition is high, therefore you need to work out what is the highest and best use of your capital. You see what I'm saying?
Yeah.
And it comes down to making sure that you understand the risks associated with each and every step. And it has to pass this thing called the sleep test, where you're not losing sleep at night over these particular strategies. Right?
So to a certain degree, it relates to just how comfortable you are with debt. And I think you could make the argument that accelerating your wealth growth process is very much related to getting comfortable with taking on debt.
Yes,
and
ultimately, your income is what drives comfort, right? Sorry to cut you off there.
Mainstream media likes to focus on debt levels in Australia, but they very seldom put any focus on asset levels and the difference between the two, which is equity. Now, they make big play of the fact that debt levels in Australia are at record levels, but also the next step, which they never get to with their reporting, is that equity levels and asset levels are also at record levels. And the important thing is that the difference between the two, equity, and that's where the comfort arrives.
Yeah, 100%, exactly. And then if you use some of that equity as a runway, this is something that a lot of investors don't really realize. Because you're an investor, you are running your own business. You have to see it as your own business, and your capital is the ammo that you're going into business with, right? Therefore, it's okay to utilize some of that capital as a runway to buy you 5, 10, 15 years worth of deficit if you're in a negatively geared property or multiple negatively geared properties. You see, far too many people sleep on that particular strategy. It's quite speculative, but it certainly buys you time, right? So if you look at it from a runway or a startup perspective, right, you can take a little bit more risk if you're comfortable with it, right? And you can utilize some of your equity to see you through in terms of the deficit over a 5, 10, 15-year period. Because you know, if you're buying a robust property, and if you're utilizing Hotspotting, if you're utilizing the right buyer's agent, if you're utilizing all of the research necessary to give you a robust property, what happens is it's a foregone conclusion that you're going to get a property that doubles in value over a 15-year period. You see what I'm saying? And the returns on investment, cash on cash, right, is upwards of 20% per annum, right? Because of utilizing your borrowing capacity, right? Very difficult to beat that within the share market, right? Now, I'm not saying go all in on property. I'm just saying you need to look at both, and you need to look at how much risk you're willing to take and how much guidance do you need if you're currently finding it hard to make that next step, basically, right?
And again, the numbers you've just ran by us talking about property doubling in value in 15 years, again, conservative. Using the rule of 72, that's an average annual growth rate of about, 5% a year?
Yeah, 4.8, exactly. Yep.
Most, as I pointed out earlier, most locations in Australia right at this point have average annual growth rates considerably higher than 5%, many are above 10%. In fact, there is some locations, some local government areas in Australia where pretty much every suburb in the last 10 years has done 11, 12, 13, 14% per year as a growth average for the last 10 years. And I know that's been boosted by the massive growth that we saw in the latter part of 2020 and throughout 2021. In some cases, it's still happening in some locations in Australia, but nevertheless, it's an average over 10 years. So it's 5% is very conservative based on the results that real estate has achieved in the last 10.
Yeah, absolutely. And like I said earlier, you want to be projecting out the conservative numbers, and you want to be surprised with the real numbers as you progress through and as you optimize and you squeeze juice out of the orange to capitalize on the potential that you've got, right? Because you want good news stories on a year by year basis, because you want small wins, because small wins build massive momentum for the future.
Yeah, okay. So it might be a good time to throw up that slide, Katie, advising people how they can make contact and set up that meeting with Andrew for 30 minutes to talk about their own situation and run some of the potential numbers that people can achieve, the doubling game, 30-minute strategy call. So what do people do, Andrew?
Yeah, so get your phone out, get the camera, click on the camera app, and then scan that QR code right there, right, with the Plenitude logo on it. Otherwise, go on your browser and just type in www.plenitudewealth.com.au/welcome. Right. So we've created a particular website for the Hotspotting audience only to access the 30-minute strategy call, because we usually have a 15-minute discovery call for people outside of this particular group, basically.
We should point out that 30-minute strategy call is free.
Correct. Yes, it is free. It is free, and unfortunately, it's gonna have to be 30 minutes or maybe a little bit less, because I have a feeling there's going to be a bunch of you booking in time, and I've got to get some work done as well in between.
Sure. What can people hope to achieve in that 25 or 30 minutes that they'll have with you?
Yeah, look, getting a greater understanding of where they're at, what kind of timeline they're working with, setting some targets for themselves so that they know exactly where they're heading towards. Obviously, getting the doubling game sorted. Right, understanding their particular numbers, and then playing a few kind of scenarios for them so that they know exactly where they're heading towards over a 5, 10, 15-year period. Obviously, some people are a little bit older and some people are a little bit younger, depending on the journey of their investment journey, right? Some people are getting on in terms of transitioning from the growth cycle to income, versus some people who are just trying to build wealth themselves. So it depends on your situation, what will determine the output of that particular meeting. But the main thing is, I'm always looking to educate and provide you with a ton of options so that you can actually make the right steps moving forward, because we're all about empowering people to get to financial freedom, or their version of financial freedom, sooner.
Is there any such thing as that it's too late to start, or is it never too late?
Well, look, I think if you've got resources in front of you, it's never too late. It's never too late. You can always optimize for a better outcome. I mean, the beautiful question that I always ask myself, my team, my clients is, how can you make it better? Ask the question of how can you make it better within the context of saving more, lowering your taxes, and investing better. And this is how you build massive momentum for the future, basically.
To turn that question around, is it ever a case that it's too early to get started?
Well, look, in the end, I don't think it is. I don't think it's too early. Like there's always a way to get better, right? So in the end, it depends what you're up to. I think if you're just starting out, I'd be aiming to increase your income, your value within the business that you're currently working in, right? So that you can demand a higher income. Therefore, and make sure your lifestyle cost doesn't creep up, because there's this thing called lifestyle creep, which everyone's guilty of, right? Where income starts to increase, lifestyle starts to increase, more avocados on toast, faster cars, bigger houses typically, right? So if you can cap what you're currently spending on lifestyle as your income increases and invest the rest, that's how you build massive momentum, because the first few doubling cycles is determined by how fast how much you can save, right? Once you get past cycle number 8 or 9, your savings rate doesn't matter as much anymore, and it becomes your return on investment in your net assets, right? That's the crucial part. Yeah.
But savings, particularly initially, is a very important part of it. And I think to a certain degree, lockdowns has done Australians a massive favour by showing them how much can be saved when you're in a position where you don't have a choice. And if you apply that principle and those learnings to everyday life out of lockdown, much could be achieved.
Oh, absolutely. And like I said earlier, right, what you do in the next 5 years will determine how comfortable you are in the next 10, right? So if you can lock in those good habits that you've picked up from the lockdowns, right? And obviously the good habits only, not the bad habits. I mean, I'm guilty of like gaining like 15 kilos or something ridiculous like that over the lockdown, right? So you want to get rid of the bad habits, keep the good habits, good financial habits, and put yourself in a position to win financially.
Yeah. Please, people watching and listening, let us have your questions. We've still got time left in the broadcast. So if you've got any questions about the doubling game or the 30-minute strategy call, let's have them now. Just type them into the Q&A panel. Ram has just mentioned, he's obviously followed the link that you put in earlier, and says the spreadsheet download doesn't work. It says an email is sent, but no email arrived. Does that make any sense?
There's probably a 5-minute lag in between you putting your details in and getting that particular PDF, basically. So keep an eye on that. It's a fairly sizable PDF with a workbook. So if it doesn't hit your inbox within an hour, Katie will be sending an email with the exact link again, and you just follow the prompts there, and you'll be able to get that particular download. Follow the prompts.
One or two people just asking, is there a phone number that can be called? Perhaps it's not working for them with the QR code, or not comfortable with that kind of technology. Is there an alternative way to book that 30-minute strategy call?
Yeah, well, look, I think the best place to go is our website. If things aren't working that way with a QR code, go to plenitudewealth.com.au and just type in, book in a 15-minute call, basically, and then just type in hotspotting, right, as one of the prompts, because we'll be sending a questionnaire so that we can save some time during our call, and we'll increase that to a 30-minute phone call for you, basically. So if the QR code isn't working, visit plenitudewealth.com.au and then just click on Let's Chat, the Let's Chat button, and we'll work through and spend 30 minutes with you rather than 15, and go through the doubling game.
Okay. So the $1 billion question, Andrew, is how are you going with the doubling game?
Well, look, Terry, I answered the question a few weeks ago when you asked me this specific question, and it depends how you value the business. Because I mean, as you're well aware, the business is the hyper leveraged asset in each and every portfolio. So if we take away the business, we're at cycle number 12, basically. So I'll let you guys do the sums on that with our personal portfolio. But if we add the business, well, who knows where it's going to be, mate. It's we're building a fairly sizable one at that. So it's a question of timing, profits, and all that kind of jazz. So I'm not quite sure, because there's about 7 different valuation styles that we can use, and all of them kind of spit out a different valuation for the business.
Valuation of a business is always kind of subjective. I'm grappling with that one myself at the moment. It depends on what multiple you apply, and which years of income that you take into account. There's so many different answers you can come up with.
100%. That's it, exactly.
Okay. Madhu, negative gearing is in a rising interest rate environment, I think seems an uncomfortable way to reduce tax, as it could be a lot out of pocket. How else can one get started? So we actually are running an article in the Week in Real Estate we'll be publishing at the weekend, where there's been some numbers published on the amount that negative gearing is likely to cost the federal government in the next 12 months. So it's probably going to double. And that's because obviously interest rates are rising. So more bigger claims will be made for negative gearing. So Modi's comment, what's your response to that?
Well, look, I'm inclined, if you are looking at acquiring a property, obviously the higher the yield, the better it is going to be for you in terms of the deficit for the negative gearing part of the equation, right? So what you need to do is make sure you're at a surplus before you look at a negatively geared property. Now, if you're not at a surplus, I wouldn't suggest you go down the path of negatively geared property. I'd be aiming for a positively geared duplex of sorts, right? Or a property that's yielding 6-7% yield kind of thing, right? To get into the market. Now, it might be an issue. It depends on where you're at in terms of your surplus, because the banks will obviously have their stringencies. And we were just running the numbers earlier for a client who we were just about to get pre-approval for a month ago. And because of the interest rates rising so fast, they now can't be pre-approved at the amount that we were hoping for, which is 380 essentially, right? So we've got to drop the price down to a buy price of sub 300 to actually get them in the market, right? So, and it's still negatively geared. So depending on the yields will determine how comfortable you are. Now, if you're not comfortable with negative gearing, well, maybe you shouldn't do it. Or maybe you should get educated or get the right guidance to get comfortable with it if you deem it necessary in your portfolio, right? So it's certainly not for everyone, but what I suggest you do is you aim for as high a yield as possible and don't fall for the trap of buying $1 million property with a 3% yield, right? Or 2.5% yield.
No. If you've got the capacity to spend $1 million on real estate, I often feel that people are better off leveraging that into at least 2, maybe 3 properties, because you're going to get the higher yields, which can compensate for the higher interest rates that we're currently paying. But also, I think people need to keep in mind that right now we're in an environment where vacancies are the lowest ever. Rents are rising very quickly. So your initial yield might be maybe break even or slightly negative gear, but in a couple of years' time, it's going to be positive cash flow if you're buying in the right location, because rents are growing typically at more than 10% a year at the moment, and unlikely to change at any time in the near future, because there's no short-term solution to the shortage being proposed by anybody, certainly not at a state or federal political level. Yeah,
100%. I mean, we're finding yields jumping up because the clients that we're buying properties for at the moment have got yields of around 5.5%, with leases ending early next year, mid next year, and we're looking at increasing it by an extra 1%, as much as 1% for some of them. Right, that's the kind of power that you're sitting on at the moment if you buy in the right spot. Now, the beauty of coming to these kinds of webinars is you get to kind of pick the brains of the likes of Terry and myself to kind of make sure that you're going at it the right direction. Right, because far too many people make a $500,000 mistake or an $800,000 mistake, not knowing that they're putting themselves back by 5 or 10 years. Right, 5 or 10 years at your arrive, strive, thrive numbers. Right, is extremely expensive. There's a massive opportunity cost out there, and far too many people aren't even aware of that opportunity cost. So you need to get savvy, you need to get educated, and you need to get guidance if you don't know what the next steps are.
Yeah. Look, I'd like to refer to a comment you made a little bit earlier, and it was along the lines of treating investment and treating the whole process that you might embark on with the doubling game as a business. And I think too few people really do treat property investment as a business. They tend to approach it as something like a hobby. And I think the people who are truly successful with it are those who do treat it as a business. They've got maybe their day business. Property investment is their second business, and with any business, you need to spend money to make money. I think that's the mistake that a lot of people don't make, that's a mistake they make. They're not willing to actually put some investment into the process of making property investment a successful business.
Yep, absolutely. Absolutely. I mean, it's akin to kind of looking at professional athletes, right? So all professional athletes have training coaches, and they're their main coach, right? They need guidance to know exactly where they're heading towards, right, to get better themselves, whether it be a role player or a star player of a team, right? What you need to do as the CEO of your company is you need to get the right team around you to ensure that A, they've got your back, and B, they're producing the output and results that you want, and C, that they're proactive in their approach so that they can squeeze as much juice out of the orange and actually capitalize on the potential you've got in front of you.
Yeah.
Right?
And one of the things I say to everyone who speaks about property investment, build your team before you build your portfolio. That's so important. Too many people start at what I would call step 7 and an 8-step process. They go straight to realestate.com.au and start looking for properties to buy without doing that initial planning, but being clear about their goals, having the strategy in place, and building a team of trusted advisors so that they can make good decisions.
Yeah, taking step 8 before taking steps 1, 2, and 3 is the best way to have an aneurysm. It's such a volatile roller coaster ride that you're on. I remember buying my first property. I didn't have a team around me. I felt the whole world was against me at that time. I was just trying to get some answers and no one was there to help, right? And it was completely my fault because I didn't do the research. I didn't do the due diligence, right? I didn't have a team behind me, right? So you need to kind of save yourself the heartache and pay through time or through your capital, because you're either paying through your time and your energy by looking for the right moves moving forward, or you're paying through time by missing out on the gains that you otherwise would have gotten if you were to pay to get some guidance from the right professionals and build that team around you to speed up the process and skip 5 years worth of lessons, 10 years worth of lessons, right? That's why there's power in getting the right team around you so that you can actually save decades of your life and then chase after the experiences that you want. Because in the end of the day, what's life all about? It's about spending time with your loved ones, getting the right experiences, and living as fulfilled life as possible, right? So if you don't have your finances in check, well, what happens is you don't have as much optionality, and therefore you can't do as much, right? Ideally, you want maximum optionality in your life so that you can do whatever the hell you want to do and actually live a good, solid life, you know?
It's a pretty good note to end the webinar on, Andrew. Thank you for that. Thank you for your presentation today. I think it's been most enlightening. It's certainly got my brain working overtime. And I gather from some of the comments that people have put into the Q&A panel that a lot of people are sort of already thinking about what could be achieved by having that 30-minute strategy call with you. So I urge people to follow up and book a session and have a chat about your situation and your numbers and have a look at the possibilities that could be achieved that may be way beyond you ever imagined were possible. Thank you.
Thanks for having me, Terry. Much appreciated.
Yeah.
And looking forward to catching up with a few of you guys.
Okay. All right. Well, thanks again for everyone for your participation, for your comments and questions, and please do follow up with Andrew Courtney of Plenitude Wealth and see what can be achieved in your situation. So, Terry Ryder from Hotspotting signing off. We'll do it again soon. Bye for now.
See ya.